You survived the terrifying reality of the eviction mill and the offset trap. You built your financial firewall, slashed your household budget to the bone, and made absolutely sure your primary mortgage payments cleared on time. You look at your home equity line of credit, the HELOC attached to your property, as your ultimate unbreakable safety net. You firmly believe that if inflation completely crushes your grocery budget, or if you suddenly lose your job during the economic contraction, but you can simply draw on that available equity to keep your family afloat. That specific belief is the most catastrophic financial illusion paralyzing the Canadian middle class today. That safety net is not a safety net. It is a legally binding tripwire. Welcome back to Canada Property Watch. Today, we are exposing the demand clause, the deeply buried, microscopic legal mechanism that allows your bank to instantly, unilaterally recall your HELOC, illegally demanding tens of thousands of dollars in pure cash within 30 days, with absolutely zero warning. To understand the sheer panic currently unfolding behind the closed doors of Bay Street risk management departments, you have to look at the psychological trap constructed over the last decade. During the historic real estate boom, major financial institutions engaged in the most aggressive consumer lending campaign in Canadian history. They saw massive, unrealized paper wealth sitting inside the drywall of your home and needed a vehicle to turn that imaginary equity into highly profitable debt. They marketed the HELOC not as a dangerous variable rate loan secured directly against your roof, but as a financial Swiss Army knife. It was aggressively sold as a flexible tool for luxury renovations, buying new vehicles, or consolidating high-interest credit card debt. The marketing message was universally broadcasted. Your house is making more money than you are working your full-time job, so why not use it as your own personal automated teller machine? Millions of Canadians took the bait, chaining their entire financial survival to a highly speculative real estate market without ever reading the fine print. Then the macroeconomic environment violently fractured. Global inflation exploded, and the Bank of Canada launched its historic and a punishing campaign of interest rate hikes to destroy consumer demand. The cost of basic human survival doubled, while wages remained completely stagnant. Faced with astronomically higher primary mortgage payments and soaring utility bills, the Canadian middle class quietly shifted their survival strategy. They stopped using their HELOCs for luxury basement renovations and started using them simply to buy time. They began drawing down on their home equity to pay for essential groceries, to cover winter heating bills, and, most terrifyingly of all, to make the monthly payments on their primary mortgages. They were actively borrowing money from the bank to pay the bank, utilizing variable rate debt to service fixed rate debt, creating a catastrophic cycle of negative amortization hidden entirely within their revolving HELOC balances. The federal banking regulators, specifically the Office of the Superintendent of Financial Institutions, commonly known as OSFI, watched this shadow debt crisis balloon to absolutely terrifying proportions. OSFI understands that a national banking system cannot survive if its primary collateral is rapidly depreciating while the debt secured against that collateral is rapidly accelerating. They issued a severe, uncompromising mandate to the major banks. They demanded that the financial institutions drastically and immediately reduce their systemic risk exposure, and demanded that the banks actively stress test their existing loan portfolios against the grim reality of a crashing real estate market, forcing them to formally provision for imminent, massive financial losses. This brutal regulatory crackdown from Ottawa collided violently with the second, but most devastating macroeconomic factor, the silent, untelevised collapse of Canadian property appraisals. Over the past 24 months, despite the carefully curated, manipulated statistics from local real estate boards, actual clearing prices for homes in major suburbs have plummeted. Homes that the banks eagerly appraised at $1.2 million at the absolute peak of the market frenzy are now struggling to find desperate buyers at $850,000. But this massive destruction of paper wealth is exactly where the trap finally snaps shut on the average homeowner. When you originally applied for your HELOC, the bank sent a physical appraiser to your property. They determined your home was worth $1 million. With a $500,000 primary mortgage, mathematically, you had massive equity. You were happily granted a $300,000 credit limit. Over the past 2 years, simply to survive inflation, you drew down $100,000, falsely believing you still had $200,000 of breathing room. You were operating under the incredibly dangerous delusion that the original appraisal from 2 years ago was a permanent mathematical fact. The bank knows it is not. The major financial institutions utilize incredibly sophisticated, constantly updating automated valuation models known as AVMs. These digital algorithms continuously and silently monitor provincial land registry data, the multiple listing service, and localized street-level comparable sales in your specific postal code. Every single time a desperate, over-leveraged neighbor on your street sells their house at a massive 20% loss as a power of sale, the algorithm instantly, automatically recalculates the value of your specific property. Suddenly, when the mathematics of your entire financial life are violently inverted without you ever receiving a notification. The bank's automated system looks at your file in the middle of the night. It sees that your primary mortgage is $500,000. It sees that your outstanding HELOC balance is $100,000. Your total debt is $600,000. But the new, silently updated automated appraisal values your home at only $650,000. You have just crossed the invisible red line. You have mathematically exceeded the newly mandated 65% loan-to-value threshold set by the federal government. You have instantly transformed from a valued, profitable customer into a high-risk, under-collateralized liability sitting like a ticking time bomb on the bank's balance sheet. You are now a toxic asset that must be immediately neutralized to satisfy the federal regulators and protect the bank's quarterly earnings. And this is the exact moment the bank authorizes the deployment of the demand clause. To truly understand the sheer, unadulterated terror of this legal mechanism, you must completely abandon everything you think you know about contract law and consumer protection. When you sign a standard, fixed-term, amortizing mortgage, you are entering into a mutually binding agreement. As long as you make your agreed-upon monthly payments on time, the bank is legally locked in. And a primary mortgage offers you a defined period of legal stability. A home equity line of credit offers absolutely no stability, no predictability, and no legal protection whatsoever. A HELOC is legally classified by the banking sector as a demand loan or a demand credit facility. If you pull out the original 50-page microscopic contract you signed, you will find a specific, terrifyingly brief paragraph deeply buried within the terms. And it explicitly states that the credit facility is payable on demand. The bank possesses the absolute unilateral right to reduce your credit limit, freeze the account entirely, or demand full repayment of the entire outstanding balance at any time, for any reason. They do not have to prove you missed a payment. They do not have to prove you lost your job. The demand clause is the ultimate financial kill switch, granting the bank total dictatorial control over your family's survival. Let us walk through the highly standardized, utterly heartless sequence of events that occurs when the bank executes your file. The process is completely devoid of human empathy. It begins with a sterile, automated, registered letter delivered directly to your mailbox. You open the envelope, expecting a routine monthly statement. Instead, you are reading a formal, uncompromising legal ultimatum from the Central Risk Management Division. The letter bluntly informs you that the bank has conducted a periodic algorithmic review of your credit facility and determined your account no longer aligns with internal risk parameters. It coldly states that your HELOC has been permanently frozen, effective immediately. You can no longer draw a single penny. But the freeze of your liquidity is only the beginning of the nightmare. The next paragraph delivers the fatal, life-altering blow. The bank officially invokes the demand clause, formally demanding that you repay a massive portion of the outstanding balance to bring the loan-to-value ratio back into compliance. The letter will legally demand that you produce $30,000, $50,000, or even $100,000 in pure, unencumbered liquid cash. And the most paralyzing part of this legal document is the deadline. They do not give you a year to sell assets. They do not give you 6 months to find a second job. The standard banking procedure in Canada dictates a brutal 30-day ultimatum. You have exactly 30 days from the date printed on that letter to wire the demanded funds directly to the bank or face immediate, catastrophic legal consequences. The psychological devastation of reading this letter in your living room is absolute. You are holding a piece of paper that mathematically guarantees the destruction of your financial future. You have spent the last 2 years desperately treading water, making the minimum interest-only payments specifically because you did not have any extra cash available. You have absolutely no savings left. Your checking account is functionally empty. Your credit cards are completely maxed out. Where on earth, in a contracting economy, are you supposed to magically manifest $50,000 in 30 days? The immediate instinct for homeowners is to borrow the money from somewhere else. They scrambled to call alternative lenders, B-lenders, and private mortgage corporations, begging for a lifeline. But this is where the brutal reality of the Canadian credit crunch permanently crushes them. The alternative lending space is not stupid. They operate using the exact same algorithmic data your major bank uses. When you apply for a second mortgage to pay off the margin call, the private lender runs an independent appraisal. They see exactly what your bank saw, that your home value has plummeted, that your equity has evaporated, and that you are drastically over-leveraged. The private lenders will categorically deny your application. Even if you find a highly predatory lender willing to take the risk, the interest rates will be extortionate. 15 to 20%, combined with thousands of dollars in upfront lender fees deducted directly from the loan. Taking that private money will not save you. It will simply accelerate your inevitable bankruptcy. You are trapped in a liquidity vacuum, cut off from traditional banking and priced out of shadow banking. As the 30-day clock mercilessly ticks down, the true, hidden, systemic danger of the demand clause finally reveals itself. The bank's demand for $50,000 is not an isolated event. It is a systemic contagion. The vast majority of Canadians hold their primary mortgage and their home equity line of credit at the exact same financial institution, often bundled conveniently together under a single collateral charge umbrella. This convenience is the ultimate inescapable trap. If you fail to produce the $50,000 by the exact date specified in the demand letter, the bank legally declares your HELOC to be in a state of terminal default. Because both the HELOC and the primary mortgage are secured by the exact same physical property and governed by the exact same master borrowing agreement, the bank instantly invokes a deeply buried, lethal provision known as the cross-default clause. This clause is a legal mechanism dictating that a default on any single credit facility constitutes an automatic, instantaneous default on all other credit facilities held with that institution. The moment the clock strikes midnight on the 30th day and the HELOC registers in default, the computer system automatically triggers a default status on your primary mortgage. It fundamentally does not matter if you have perfectly made every single primary mortgage payment on time for 15 years. The cross-default clause overrides everything. The bank legally accelerates the entire massive debt. They demand not just the $50,000 from the HELOC, but the entire $500,000 balance of the primary mortgage, payable immediately. You have now been pushed completely out of the retail banking division and handed directly over to the eviction mill. The bank's external law firm takes over the file. They issue the formal notice of sale under mortgage, adding thousands of dollars in predatory legal fees to your outstanding balance. The drive-by appraisals begin. The neon eviction notices are stapled to your front door for your neighbors to see. The bank moves with terrifying, automated speed to list your home on the market as a power of sale, dumping it at a massive 20% discount just to rapidly recover their principal loan amount. This fire sale completely wipes out whatever tiny fraction of equity you had left and leaves you with a lifetime deficiency judgment that will legally garnish your future wages until the day you retire. They use the demand clause to test your liquidity, and when you failed, they used the cross-default clause to legally steal your house. We must critically examine why the banks are allowed to operate with such absolute unchecked power over the lives of Canadian citizens. The reality is that the regulatory framework in this country is designed specifically and unapologetically to protect the structural integrity of the major financial institutions at the direct expense of the individual consumer. The federal government and regulators are perfectly aware that the banks are aggressively recalling HELOCs. They are perfectly aware that these margin calls are forcing thousands of working-class families into foreclosure, but they view this as a necessary completely acceptable collateral damage to prevent a broader systemic collapse of the banking sector. The banks are currently engaged in a desperate silent purge of their balance sheets. They know the Canadian real estate market is fundamentally broken. They know the massive wave of mortgage renewals approaching will trigger a tsunami of defaults they cannot possibly absorb. Therefore, they are utilizing every single legal mechanism at their disposal to forcibly deleverage their most vulnerable clients right now. They are using the demand clause as a preemptive strike, using sophisticated algorithms to identify homeowners living on the razor's edge of insolvency, and liquidating their assets to protect quarterly profits and ensure shareholder dividends remain untouched. They are actively socializing the massive risk of a housing crash by transferring the devastating financial losses directly onto the shoulders of the working class families who trusted them. The mainstream financial media is entirely complicit in maintaining the deafening silence surrounding this crisis. You will rarely, if ever, see a primetime news segment discussing the predatory nature of demand loans or explaining the catastrophic impact of cross-default clauses. When the television networks rely on the massive multi-million-dollar advertising budgets of the big six banks, they will continue to run heartwarming commercials showing smiling couples unlocking the doors to their new homes, while their highly paid economic analysts confidently assure the public that the banking system is resilient. They will never show you the terrified family sitting at their kitchen table, staring at a 30-day demand letter, realizing that their financial life has been legally terminated by a computer algorithm. If you are a Canadian homeowner and you currently have an outstanding balance on a home equity line of credit, you are standing in the direct path of this automated wealth extraction machine. You cannot afford to operate under the delusion that your bank is your trusted partner. The rules of the game have been violently rewritten, and the contracts you signed years ago are now being aggressively weaponized against you. You must take immediate, aggressive, defensive action to protect your family from the demand clause before the registered letter arrives in your mailbox. The ultimate defensive strategy requires you to completely eliminate the bank's legal ability to demand the funds on short notice. You must proactively eliminate the revolving nature of the debt. If you have any equity remaining, and your current income can support the debt service ratios, you must immediately contact your bank or an independent mortgage broker and demand to term out your HELOC. This means formally converting the variable, callable line of credit into a fixed-term, amortizing mortgage portion. You are legally changing the classification of the debt from a highly dangerous demand loan to a much safer term loan. Yes. Then implementing this strategy will likely lock you into a higher interest rate on that specific portion of debt. Yes, it will force you to start paying down the principal immediately, significantly increasing your monthly cash outflow and destroying your remaining disposable income. It will be incredibly painful for your daily household budget, but that intense financial pain is the exact premium you must pay to buy back your legal security. When you term out the debt, when you permanently remove the bank's unilateral right to recall the loan at a moment's notice, you force them into a binding contract that guarantees your family a defined period of stability. You strip the weapon completely out of their hands. If you cannot qualify to term out the debt because your ratios are already too tight, you must fundamentally restructure your entire financial existence today. You must enter a state of absolute, uncompromising financial austerity. You must sell any non-essential assets, liquidate your tax-free savings accounts, sell the second car, and aggressively, relentlessly attack the principal balance of that HELOC. Every single extra dollar you earn must be deployed as a shield against the bank's algorithm. You are not just paying down debt. You are buying distance between your family and the eviction mill. You must reduce your loan-to-value ratio below the critical 65% threshold before the automated valuation models trigger the alarm on your file. We are entering the most volatile, destructive phase of the Canadian real estate collapse. The era of cheap, infinitely available credit is dead and buried. The banks are no longer your enthusiastic lenders. They are your aggressive, calculating adversaries, desperately trying to extract their capital from a burning building. And they will absolutely use your family's equity as a stepping stone to escape the flames. Subscribe to Canada Property Watch. We will continue to dissect the contracts, expose the hidden legal traps, and provide you with the unvarnished, terrifying intelligence you need to survive the brutal realities of the Canadian banking system. Do not wait for the registered letter to arrive. Do not trust the system to protect you. Take control of your balance sheet to provide, fortify your defenses, and protect your home at all costs. We will see you in the next investigation.